The Money Show.
Personal Finance with Warren Ingram.
24 minutes now to 8 at the time. Well, one of the great sort of fears that seems to be emerging more and more, one of the great conversations is there a bubble in international stock markets, and particularly in the US? And Warren Ingram, the certified financial planner at Galileo Capital, has decided, cheerfully, Warren, I noticed that this is what we should talk about tonight. What to expect if the stock market crashes. You know, as always, your questions for Warren, 011 883 0702 021 446 0567, and we'll take your voice notes as well on 072 702 1702. Warren, good evening. We spent a lot of time trying to work out what's going to happen in the next year, and actually, as I suppose you remind us, we don't really know a thing.
It's such a game we play, I think, as an industry, but also as humanity. You know, when we wake up every morning, I don't know if you do it, I do it. I open my phone and I look at the weather app as if that's somehow reliable and it's actually going to tell me what's really going to happen. And we do the same thing with our investments. We listen to very clever strategists and economists, and they give us very detailed reasons as to why the markets are going to go up or down, or whatever it is that they're forecasting for the month and the year ahead. And somehow we feel better that we've been given this very clever sounding forecast, and now we know what's going to happen. So we value the certainty, and then, like our weather app, we get severely disappointed when things don't work out as promised. And you're right. We're living in a time now, Stephen, where I'm so tired of talking about the bubbles, but that's what people want to hear. Is they want to understand: are we in a bubble? Is it going to burst? When is it going to burst? You know, what day exactly? Maybe down to the minute. And then kind of giving them the answer, which is for them deeply unsatisfying, where you say, "Gee, I don't know." You kind of leave them unsatisfied, and so I thought, how can we help people maybe get a parameter of certainty? In other words, if it crashes, and that's certainly not a forecast I'm making. I'm humble enough to say I don't have a clue what's going to happen tomorrow. Forget about 12 months' time. But if it's going to crash tomorrow, what does that look like, and what should we prepare ourselves for?
We talk about this as if it doesn't happen often, but do markets fall often? And I know at some point we need to remind ourselves that over the longer term, markets always grow.
Markets do always grow, and they have always grown despite many predictions of calamity and the end of the world. Somehow markets survive and continue to thrive. And we also know one of the good adages is that when America sneezes, the rest of the world catches a cold. And that might not be as true for the dollar, for example, as it used to be, but it's certainly true for the American market. If the American market has a big crash, it will affect all other markets for a period of time. And so understanding what happens with big market crashes in America is key to understanding how we will be impacted. And in the US, the American market falls, and when I say falls, I mean if you measure it from the 1st of January to the end of December, it falls 1 out of every 4 years. So you take a typical 4 or 5 year period, and you would expect the market to have 1 year where it is negative. And so it's actually rather common. A quarter of the time, you lose money by being in the market over a year. What's interesting is how surprised people are, and whether it's people like you and me when we're talking about this stuff, or investors who just happen to have money in the markets, or professional investors always seem surprised after a market fall. And the truth is, it happens quite frequently. What's maybe more helpful is to understand, what does that look like when the market is down over a year? And typically it's going to be down about 13%. So if you started the 1st of January, let's say we're on the 1st of January 2026, we've got R1 million in the markets. By the end of the year, we would expect that to be down an average of 13%. In other words, 31st of December, our R1 million is now worth 870,000 rand. So that's the typical movement of an average down year. And I think, that's the context we should be ready for, is if there is a correction or a crash or whatever you want to call it. I know people don't like using the word crash. We should talk about it. But that's what we would expect, is that it's typically around 13% a year.
The fall can be a lot bigger, can't it? I mean, you can have a fall that's a lot worse than that. I mean, particularly if you go back to the global financial crisis. I mean, wasn't it more than that? That was a big thing, though.
It was, and maybe, not a lot of people are talking about the IT bubble in 1999 up to the year 2000, because that's somehow related to tech, and now the fear is that we're in another version of that. And 2000 and the year 2000 and the 2008 crash, you were looking at a fall of about 40% over that 1 year period. So again, you start the year with 1 million and you end the year with just fractionally more than 600,000 by the end of December. So it is a big number. And what's frightening about that is not the fall, it's how badly people respond to that. Because what they do, and we do it en masse, we see it happen, but through thousands of investors, that they remain fairly logical, fairly rational for the first 5% of the fall, then the next 10, and then the next 15. But somewhere along the line, at I don't know what the number is, 20, 25%, people really start to panic. And then they flood the market with their shares. They sell because they believe it will not recover. And of course, as you said, markets tend to go up over long periods of time. So they make a catastrophic mistake, but we do it en masse.
We need to talk about averages here, and averages are basically the key, I suppose, to investing, along with diversification. But over averages, I mean, we've had such a great year on the JSE this year, and you kind of want that to continue. But we should realize that it is higher than average. What do averages tell us over the longer term?
So I mean, I have to give you a real dad joke here, but if your head is in the fire and your feet is in an ice block, the middle of your body is on average fine, but yes, the ends are in real trouble. And so we need to talk about averages because they hide a lot of noise and sometimes they hide some potential dangers. And so when you're investing in shares and we're talking about a 5-year or 10-year period, you would expect your investment to grow by somewhere around 10 to 12% a year. That's the normal. But as you said, I mean, this year has been a fantastic year on the JSE. So way more than that, probably double, if not, who knows what the last few weeks of the year delivers, but maybe triple that. And just a phenomenal time in the market. And so, we should be rightfully saying, that's wonderful. We also need to know that it can't continue. The market just doesn't give you 20 to 30% year after year after year. If it did, none of us would be working. We'd all be professional investors. So we should anchor ourselves around that 10 to 12%. And when the market gives you much more than that, we should be prepared to say, okay, we should look at this with a lot more concern, a lot more consideration for what might happen differently next year. The only guarantee that you have with markets is whatever happened over the last 12 months almost definitely won't repeat itself in exactly the same way over the next 12 months. So it's very unlikely that we get another big year. We might get a flat year, we might get a down year. But what's not going to happen is we're not going to get a repetition of what happened. And maybe with these averages, when we're talking about 10 to 12% a year, when you measure this over 5 years, what actually happens if you had to look at it from 1 year to the next, more likely your returns are giving you 20%, and then it's 28%, and then it's down 15%, and up 14%, and then down 1%. And when you do the average, it looks fine. It looks like it's 10 or 12% a year. But it's been a heck of a roller coaster ride in that time.
I mean, what that really tells you is that actually to invest over the long term, you have to be able to handle the volatility in the short term. You have to expect volatility. You have to expect a loss of 15% at some point.
Exactly right. And if someone said to me, give me a firm forecast for next year, what are you expecting? I'm going to say that over a typical 1 year period, the market is down by an average of 13% and up by an average of 21%. So your range of returns that you should expect over 2026 is somewhere between positive 21 all the way down to minus 13. And somewhere in there, I would expect the market would give us the return. And yes, it could be higher and it could be a lot lower, but that's the typical range of the markets over a normal 1 year period. And we shouldn't panic and freak out if that's what we see next year, where the JSE is down 11% and we think, this has never happened before and it's the end of the world. It's just another year on the market.
Okay. Your questions for Warren Ingram, voice notes on 072-702-1702. What to do if the markets do crash next year? Warren, what happens if there is a big crash? And I really do mean something like the global financial crisis. I don't want to, think of 1929, because that, I'm hoping, was a once-off, was something very different. But a major downturn. I mean, what can you expect in that scenario?
Okay, so a very quick history lesson. The reason that we can all be fairly comfortable that 1929 doesn't happen again is because the banks at that time were really unregulated. And if you were doing nothing wrong and you'd been paying your mortgage every month, and the bank was in financial difficulty in 1928, for example, they could knock on your door and say, okay, Stephen, we know you've been paying your mortgage every month, but we would like you to now repay the remaining 7 million rand of your bond by next week, or we're taking your house. Now, that's what they could do. Nowadays, they're not allowed to do that. So there is a lot around the regulation of banks that will prevent that kind of really bad behavior. And so if we're in a big crash, let's say it's a 40% year. What you should understand is that the big dips, they last somewhere around 8 months at the shortest, to around 24 months as a normal kind of longer period. And the average is around 16 months. So just, a year and a quarter. And what that means is if you started the year with 1 million, you ended, December at 600,000, it could take another year for your 600,000 to get back to 1 million. And that would be normal. That would be the thing you should anticipate. And a 1 or 2 year period where the markets are down might feel like a lifetime if you're looking at your statements every single day, but actually over a 5 or a 10 year period, that's a very small period of time, and certainly is part of what's happened in the history. So again, reminding people, when we talk about expecting to get 10 to 12% per year over 5 or 10 years, that includes years where you're seeing your market portfolio go down 40%. It's normal. You should be okay with that.
So you have to just ride it out.
It sounds like such an easy thing to say. Just ride it out. That guy on the radio has just told us all to ride it out. Yeah, be calm and carry on. This too shall pass. But it's exactly what we should do. And the truth is, we're not wired psychologically to deal with this. We want to take action. When something happens, our fight or flight, urges kick in, and so we want to do something to prevent more losses and actually take action to correct the problem and regain the money that we've lost. And one of the things to understand is you can't anticipate the crash, and there is certainly nothing you can do to anticipate the recovery. And recoveries happen very quickly. And so, we could be all, sort of doom and gloom and worrying about, the end of the world because the market's been going down for 12 months. And then all of a sudden we wake up one day and we go, hang on, for the last 2 months, it's actually been going up, and it's been going up very strongly. And there's been so much bad news in the world that we haven't paid attention to share prices. So the news and the markets are very different. And so I would say, if we're in this next year and we're sitting in October and everything's down, 40%, and you ask me what we're going to do, I would be saying to you, we just ride it out. If anything, let's not look at our statements so regularly, and let's focus on, positive things like the weather and the Springboks and whatever else that we can, because the market will do what it does. It will recover.
Indeed. We're talking to Warren Ingram tonight. There's a question, Warren, for you from Emily. She says, hi, I'm supposed to host my family for a Christmas lunch this year. There are usually 12 people who come to the family Christmas. We rotate houses to spread the load. My problem is I actually don't have enough money to do a proper lunch for everyone. What should I do? That's from Emily. We'll have an answer for you, Emily, after this.
The Money Show. Personal Finance with Warren Ingram.
7 minutes to 8, and Emily's question for Warren. I'm supposed to host 12 people who come to my house. We rotate houses, but I don't have enough money to do a proper lunch. It's a difficult one, Warren, especially when other people have hosted you in the past.
It's so typical of this time of year where people are financially pressurized and they feel shame or embarrassed because they can't buy the presents for their nieces and nephews, or potentially even their own children or their grandchildren, or in a situation like this where Emily needs to put on the spread and she just doesn't have the money. And unfortunately, a lot of the time, people resort to debt to deal with this. Instead of facing the problem head on, they load the credit card and set themselves up very badly for debt during a very expensive time of year. And so my suggestion, Emily, is to be clear, is to be kind. I would be speaking to the family. They are your family, and just being honest. I don't have the money. I know it's my turn, and I know I'm supposed to be able to do this, but I simply can't. And then find the solutions together. So sometimes it's a case of asking everybody to bring a bit a dish or whatever it is, whatever they can contribute to the meal. And I think often in this situation, we worry about what everyone else is thinking. And I can tell you, they're probably dreading next year because it's their turn and they don't have the money. And so being the first person to be clear about what's going on might take a whole lot of pressure off everybody. And frankly, catering for 12 people is a very expensive exercise. I'm not sure I want to be doing that on my time off. So maybe spread the load is the one suggestion, or secondly, tell everybody and see what they come up with. And you never know what people value in a situation like this.
And just the honesty is always the thing. Okay, so let's just return to our main comment. We're worried about markets possibly crashing next year. Is there anything we can really do right now to sort of deal with our worry? And I don't know if I need to ask you as a psychologist or as an investor.
Both, because I think this is where we get to the art of investing rather than the science. The science tells us that we can measure the valuation of markets, and the valuation says that the tech sector in America is phenomenally expensive. There isn't a way to justify those valuations. And when you look at valuations in the rest of the world, they are much more compelling. So even the JSE, after a very good year, is still better value than the American tech sector. And if you go across the globe, that answer is true for all emerging markets and potentially some of the other developed markets. So the science tells us that we should allocate more money to the better value markets and reduce our allocation to the expensive markets. So very simply, you shouldn't be overexposed to the tech sector in America now. You should be more exposed to emerging markets. But the art of this is that the American market can carry on running next year. It can do very well. So don't sell out of everything, out of all of your tech shares. Reduce your allocation to tech and increase your allocation to other sectors. Make sure you're not overexposed to the stock market in general, and make sure you've got a good spread between South Africa and overseas, because we don't know what's going to happen next year. And it could be another great year for the JSE and maybe a terrible year for America, in which case you don't want to be all global and no local.
I suppose what it also means is you need to just think about what the scenarios are and who would be affected. And I mean, I suppose you talk about the valuations for tech shares. It certainly makes sense to me that the shares that are the most expensive will probably fall the quickest, because that's actually the share that really has grown so quickly over a short period of time.
Yeah. Unfortunately, what we do, though, it's human nature, is that we look at the thing that's done incredibly well and we almost form an emotional attachment to that. And we say, why on earth would I sell NVIDIA after it's done so well for me over the last 2 or 3 years? It's going to carry on doing that forever. And why on earth would I go and buy South African shares when they've been so terrible for the last decade? And if you'd made that decision at the start of last year, and it would have been a very bad call to avoid the JSE. So I think you need to be clear with yourself that when you've done very well, take profits. Don't be afraid to sell some of your exposure to the things that have done incredibly well for you. And if they continue to do well, that's fine, because you still have an allocation to them. But you should be reallocating to the cheaper parts of the world markets and enjoy that ride over the next 2 or 3 years. They might not deliver very well next year, but low valuations are a great protection against a market crash. If if something's already cheap and it's a good business or it's a good index, it won't get a heck of a lot cheaper compared to something that's phenomenally expensive.
Warren Ingram, thank you very much indeed. Certified financial planner at Galileo Capital. Probably worth already just getting ready to share this podcast. I'm sure there are one or two jittery investors that you know, and maybe just prepare them for what they might be a bit nervous of. Warren, thank you very much indeed.